good morning, good afternoon, good evening to everyone. Today we are going to start a very important topic called foreign exchange derivatives. That means in this chapter we are going to learn how to hedge foreign currency risk. Various methods of foreign currency hedging we will see in this chapter. So what is the scope of our work for this chapter? In this chapter we are going to learn various risk hedging techniques like forward contract. Some knowledge of forward contract you already have. Then denomination in local currency, foreign currency accounts, leads and lags, netting, money market hedge, very important, currency options, again very important, currency future, caps and collars. So the last 5 or 6 one are very important, plus the first one, forward contract. They are very important in this chapter. They will also help you in your practical life later when you deal in foreign exchange. So our first risk hedging technique would be today forward contracts. Forward contracts, we are aware, a contract entered into today to buy or sell foreign currency at a future date at a predetermined rate. That is, rate is negotiated today, but the actual execution will take place at a future date. So that is a forward contract. You fix the rate today and at that rate you buy or sell the foreign currency at a future date. That is forward contract. So let us understand what is a forward transaction. A forward transaction, also called outright forward, is a transaction requiring delivery at a future date. First feature is the contract will require to be settled at a future date. One party will pay home currency, the other party will pay foreign currency at a future date of a specified amount. The amount is specified well in advance of one specified currency. The currency is specified in advance for a specified amount of other currency. The exchange rate is determined at the time of entering into the contract. So that is the wonderful advantage of forward contract. You lock the rate in advance and then the transaction will occur at that rate only, irrespective of whatever is the market rate on that date. But the payment and delivery is taken on maturity. So forward contract can be used for hedging purpose. You lock the rate in advance. We'll take some example in a minute. Wait for just 2 seconds. Forward contracts can be trading at par. Forward contract can be at premium. Forward contract can be at a discount. So what do you mean by forward is trading at par? Forward is trading at par means forward rate is same as the spot rate. Forward rate is same as the spot rate. F is equal to S. Forward premium. What do you mean by forward premium? The currency is said to be trading at a forward premium if the forward rate or the future rate that they have agreed is greater than the spot rate. This future is greater than spot rate or forward rate is greater than spot rate. The currency is trading at a premium, but this statement is true if the type of quote is a direct quote. If the type of quote is a direct quote, then this statement is true. In case of indirect quote, F is less than S. In case of indirect quote, F is less than S, then we'll say the foreign currency is trading at a premium. What do you mean by forward discount? Forward rate is less than spot rate in the case of a direct quote. Then we can say foreign currency is trading at a discount in the forward market. Such knowledge is important for designing some strategies, taking decisions, comparing different options. How to move from spot rate to forward rate? So you will have to write down this diagram either in your book or in your notebook. Spot rate is given, buying rate and selling rate is given, and suppose you are given forward margins. which are in ascending order, forward margins which are in ascending order, then in that case it means the currency is trading at a premium. Add the premium to the spot rate, then you will get forward rate. Suppose you are given spot rate and you are given forward margins or swap points which are in descending order. That means the forward is at a discount. Deduct the discount from the spot rate, then you will get the forward rate. So I request all of you to please draw this diagram. Spot rate, left side add premium, you will get forward rate. Then right side spot rate less discount, you get the forward rate. This conversion from spot rate to forward rate we have done in the basics of foreign exchange management chapter. That knowledge will be required today also. Now we'll come to examination question. One of the examination questions which they have asked many times, that whether to hedge or whether not to hedge, and secondly the question can be from importer's point of view or the exporter's point of view. The question can be importer or exporter, and the question is what is the benefit of entering into the forward contract. So one table which we have drawn here is from the point of view of the importer. An importer has to pay the foreign currency and he is wondering whether I should take forward cover or not. So I will calculate the gain or loss if he goes for forward contract. So what I will do, if he takes forward cover, I will calculate amount to be paid as per forward rate. Then I will compare it with the amount to be paid as per spot rate and gain or loss. So if the amount to be paid as per forward rate is less than the amount to be paid as per spot rate, there is a gain. If the amount to be paid as per forward rate is more than at the spot rate, there is a loss. So this is the gain or loss that will arise if the importer takes a forward contract. And they will also ask you, evaluate the gain or loss if he does not hedge. Suppose he does not hedge, his choice, he may not hedge. Then in that case, we will calculate the expected spot rate. This expected spot rate is given to you in the problem. If not given, they will give you some probability distribution table, and based on that you have to calculate the expected spot rate. So either they will simply say the dollar will appreciate by 10%, dollar will depreciate by 5%, rupee will appreciate by 10%, rupee will depreciate by 5%. Then in that case take that. Otherwise they might give you a probability distribution table, exchange rate and probability, and then they might just give you some exchange rate with some probabilities, and you will have to find out what will be the expected exchange rate on maturity. Based on that you calculate how much amount you will pay based on expected spot rate. Amount that you will pay as per the spot rate, take the difference. If the amount to be paid as per expected spot rate is less, it is a gain. If the amount to be paid as per expected spot rate is more, it's a loss. So calculate gain or loss. Now you compare these two. If you take forward cover, suppose the loss will be 2 lakh rupees. If you do not take forward cover, suppose the loss will be 3 lakh. Then in that case your decision would be the importer should enter into a forward contract because the expected loss is lower, right? The problem can be from exporter point of view also. In case of exporter, you have to calculate the gain or loss if the foreign currency is to be received. So here my all this paid will become received. Amount to be received at per forward rate for exporter, amount to be received as per spot rate. Gain or loss, if the amount to be received as per forward rate is more than the spot rate, gain, otherwise loss. If you don't take forward cover, calculate the amount to be received as per expected spot rate. Calculate the amount to be received as per spot rate, gain or loss. Compare this gain or loss with this gain or loss. Now suppose here the gain is 3 lakh and here the gain is 2 lakh. Then I will say forward is better. But suppose here the gain is 3 lakh, here the loss is 4 lakh, gain is 3 lakh, gain is 4 lakh. Then I will write the conclusion, not taking a forward cover is better. So accordingly we will calculate the gain or loss depending upon whether it is importer or exporter and take a decision. So highly tested question in the exam is whether the importer or exporter should use forward market for hedging or should not hedge at all. So now we'll solve question number 1. This question is an exam question long back, May 1998, but similar questions are still getting repeated. A company operating in a country has dollar as its unit of currency, has today invoiced sales to an Indian company. So who is an Indian company? Importer. The Indian company is importer. And who is this American company? American company, exporter. Because that currency has dollar as its units of currency. So you can understand that the exporter is American. Exporter is American, importer is Indian. First you have to understand this, then only I will proceed further. An American company has exported goods to an Indian company, the payment being due in 3 months. So Indian importer will make payment to US exporter after 3 months from the date of invoice. The invoice amount is $7,500. The invoice amount is $7,500. Dollar is the currency of exporter. Dollar is the currency of exporter. So is the exporter exposed to exchange risk? No. Is the exporter exposed to the exchange risk? You should say no, because his home currency is dollar and the import is also invoiced in dollar. So he will receive $7,500. He does not have to convert. Then who is exposed to the foreign exchange risk? It is the importer who is exposed to the foreign exchange risk. It is the importer, the Indian importer, who has to convert rupees into dollar. So it is his risk to convert rupees into dollar, and if the rate of exchange changes, he might have to pay more rupees per dollar. And today the spot rate is dollar 0.025 is equal to rupee 1. Dollar so much per rupee is given. It is anticipated that exchange rate will decline by 10% over the 3 months. So this is called anticipated exchange rate. Expected rate. Expected rate is that after 3 months, this exchange rate, which is $0.025, may decline by 10%. So it will become rupee 1 equal to, I will keep rupee 1 as it is and I will make adjustment in the dollar part. So the exchange rate after 3 months will become 0.025 minus 10%. So that is 0.0225. So this is the expected spot rate after 3 months. In this question, the expected spot rate is given by giving you the depreciation in Indian rupee by 10%. And in order to protect the dollar proceeds, the importer proposes to take appropriate action through foreign exchange market. You are an importer. In case of importer, if home currency is depreciating or foreign currency is appreciating, he will suffer the loss. Importer suffers loss when foreign currency appreciates or home currency depreciates. So what he wants to do, he wants to hedge himself by taking appropriate action through foreign exchange market. Now he goes to a bank and asks for what is the ongoing 3-month forward exchange rate. The 3-month forward exchange rate is quoted as $0.0244 per rupee. $0.0244 per rupee. This is the forward rate. In this question, the rates are expressed as 1 rupee equal to how many dollar, and we will also keep that in mind while solving the problem. So we got the spot rate which is given in the problem 0.025. We got the expected rate, and now they have also given you forward rate. Then what is the question? You are required to calculate the expected loss. So expected loss and show to what extent it can be hedged by the forward contract. So I will have to compute expected loss under no cover and under forward cover using the rates given in the problem. So we will calculate this loss, and we will have to write a comment that by taking the forward cover, to what extent your loss is hedged. Right? So write down one by one. Present the answer neatly by writing a heading of a table. We are going to prepare a table. One table without hedging, one table with hedging. Calculation of expected loss. And the reduction in expected loss. By taking the forward contract. Calculation of expected loss and reduction in expected loss by taking the forward contract. So what I'll do, you can present the answer in many formats, but this is a simple one to compare also side by side. First column, no forward cover. Second, forward cover. No forward cover taken. Forward contract taken. Now, point number A, invoice value in dollar. Point number A, invoice value in dollar. 7,500. Point B, spot exchange rate. Spot exchange rate dollar per rupee. 0.025. Now here you can ask a question, can we convert into rupees per dollar? You can do it, but I will suggest not to do it, because then while calculating the expected rate, you might make a mistake. Okay, because the depreciation 10% is given for rupee, not for dollar. So here if I am given rate for rupees, and the depreciation in rupees, I will just take minus 10% expected rate. But if I convert rupees per dollar, then I will have to be careful while estimating the expected spot rate after 3 months. If you are careful, you can do it. But for the timing, let us write like that, and I will show you your answer will not change if calculations are done properly. Point number C, write down invoice value in rupee at spot rate. Invoice value in rupee at spot rate. This is what you would have paid. You are an Indian importer. You have to pay $7,500. Rate is dollar per rupees. So you divide. You would have paid 3 lakh rupees at spot rate. You would have paid 3 lakh rupees at spot rate. But the payment is not to be made today. Payment is to be made after 3 months. So we'll calculate how much amount we will pay at the end of 3 months. For that, I need first the exchange rate. Expected spot rate after 3 months. Dollar per rupees. We have been given dollar per rupees. We are given that exchange rate declines by 10%, means dollar depreciates by 10%. Rupee depreciates by 10%. If rupee depreciates by 10%, 1 rupee will fetch you less dollar, minus 10%. 0.025 minus 10%. This is 0.0225. And in this column, write the forward rate which they have negotiated with the bank. 0.0244. 0.0244. Now, if they wait for 3 months to make the payment, the actual payment will be made at expected spot rate or the forward rate. So we will now calculate amount to be paid after 3 months. Amount to be paid after 3 months in rupees. A upon D. If you do not hedge, you will end up paying 3,33,333. And if you hedge, you will pay 7,500 by 0.0244, 3,07,377. Therefore, expected loss. C minus E in rupees. You would have paid 3 lakh, but because of change in exchange rate, you will pay 333, and therefore you will end up paying more, 33,333. This is your what we can call transaction loss or expected loss. Similarly here, if I take a forward cover, of course I'll pay more, but my loss will be 7377. So your first question was what is the expected loss that we have done, and reduction in expected loss by taking the forward cover. By taking forward cover, loss is 7377. Without forward cover, the loss is 33,333. So therefore the decision to take forward cover is right here, as your loss will reduce by this much amount. So close the table first, and below the table you write down reduction in loss by taking the forward contract. Reduction in loss by taking the forward contract. Reduction in loss by taking the forward contract. 33,333 minus 7377. Check the calculation. 25,956. 25,956. Okay. So this answer is over, but then there is a query of the student, can I take rupees per dollar? Every time they ask this query. If you want to take rupees per dollar, Suppose student is insisting take rupees per dollar. So the rate will become spot rate 1 divided by how much? 0.025 reciprocal. So this is 40 rupees actually. And what about this expected rate? Expected rate will become 40 divided by 0.90. Divide by 0.90. If rate is given dollar per rupees and they are giving you rupee depreciates by 10%, it means dollar will appreciate but not by 10%. So to get the rate for dollar, I will take 40 divided by 0.90. 40 divided by 0.90, it comes to 44.4444. Okay. Now 7500 multiplied by 44.4444, what is the answer? So you will be happy to note that if I take this rate, my answer is still 3,33,333. So as I said, if you do the calculation correctly, answer will be same. So those who want to take rupees per dollar, take 40 here, take 44.44, 44.4444, then your answer will be matching. If you take 40 and then 40 plus 10, 44, answer will not match and you can lose 50% of the total allotted marks for this question. Okay, we'll take question number 2. Now you see the first question was asked in 98. Next question they have asked in 2003. And then after a gap of few years, they keep asking such questions. So let us solve one more time. AS Limited operating in Japan has today effected sales to an Indian company. The payment being due 3 months from the date of invoice. The invoice amount is, so first important thing, 3 months. Second is 108 lakh. AS operating in Japan has today effected sales to Indian company. Exporter is Japanese company and importer is Indian company. Important thing, as you have noted, invoice is in yen. So Indian importer is at risk. Japanese exporter does not have exchange risk because the invoice is denominated in his currency. So he will get 108 lakh yen. It is the headache of the Indian importer to convert rupees into yen and then make the payment. At today's spot rate, it is equivalent to 30 lakh. So in this question, the exchange rate today is not given, but they have given 108 lakh yen is equal to 30 lakh rupees. So this can be converted into 108 divided by 30. We can say the spot rate is 3.60 yen per rupee. If you want to quote in rupees, spot rate is 3.60 yen per rupees. If you want to quote in yen, 30 by 108 we will take. Now the problem says it is anticipated that exchange rate will decline by 10% over 3 months period. This paragraph they have copied and pasted from the previous problem. Exactly same thing. It is anticipated that exchange rate will decline by 10% over 3 months period, and in order to protect the yen payment, the importer proposes to take the appropriate action in the foreign exchange market. The 3-month forward rate is presently quoted as, now you see here the rate is given 3.3 yen per rupee. That means in this question also the rate is given for rupees. So we will take the spot rate also as 3.60 yen per rupee. and the 10% decline which they have mentioned is also interpreted as decline in rupees. Although one can challenge the question by saying that exchange rate will decline by 10%, not mentioned which currency, yen or rupees. So we will assume that since the rate is for rupees, the depreciation 10% will be affected on rupee. Rupee will depreciate by 10%. Last line again they have copied and pasted. You are required to calculate the expected loss and to show how it can be hedged by a forward contract. Only difference is instead of dollar, now it is yen, and the spot rate, instead of given directly, they have given the invoice value in equivalent rupee amount, from which you can find out the spot exchange rate. Otherwise the question was exactly same. So please write down, dear student, same heading, same format, one more practice. So 2 times we are practicing any similar type of problem. There are many more times similar questions are asked, but now that will only be repetitions. Before you start the answer, write the heading of the table. If you are preparing in a tabular format, calculation of expected loss. 2 questions in the same table. First is we'll calculate the expected loss, and second, reduction in expected loss by taking the forward contract. Reduction in expected loss by taking the forward contract. Reduction in expected loss by taking the forward contract. Serial number, particulars, and then 2 columns on the right side. Forward contract, no forward contract, and forward contract taken. Forward contract taken, no forward contract taken, and forward contract taken. Write down first point number A, invoice value in yen. Invoice value in yen 108. In bracket in lakhs. One more thing, write down in lakhs. In lakhs. Point number B. Point number B, first write down spot rate, keep the line blank. Come to the third line. Third line, write down invoice value in rupee at spot rate. Invoice value in rupee at spot rate. Write the third line first. In bracket in rupees lakhs. In rupees lakhs. 30 lakhs, 30 lakhs. Now you come to point number B, where you have written spot rate. In bracket write yen per rupee. Yen per rupees. Yen per rupees. Then write down A by C. A by C. 3.60 yen per rupees. 3.60 yen per rupees. Because in the question the forward rate was also given in yen per rupees, so I will keep the same format. If you want to write rupee per yen, you can do it, but while calculating the expected rate, divide by 0.90. Okay, then your answer will match. Now write down expected spot rate oblique forward rate. Expected spot rate for the first column, forward rate for the second column after 3 months. In bracket yen per rupees. Yen per rupee. Expected rate would be spot rate minus 10%. 3.60 minus 10%. 3.24. Forward rate is given. Forward rate is given 3.30. Now write down amount to be paid in rupees after 3 months. Amount to be paid in rupees after 3 months. 33.33. In bracket write down rupees lakhs. Rupees lakhs. in bracket rupees lakhs, and in the next column 32.73. So now what we'll do, we'll calculate the expected loss, what we were supposed to pay and what we ended up paying. So we were supposed to pay 30 lakh, but due to change in the exchange rate, we will end up paying 33.33 lakh if we don't hedge. So therefore the expected loss could be 3.33 lakhs if you don't hedge, and if you hedge, your expected loss will be 2.73 lakhs. So therefore write down one note. So there are two questions. What is expected loss? Done. Reduction in expected loss if forward contract is entered into. Reduction in expected loss if forward contract is entered into. 3.33 minus 2.73. 3.33 minus 2.73, and that is equal to rupees 0.60 lakhs. That is equal to rupees 0.60 lakhs. That is equal to rupees 0.60 lakhs. So if the question is, should the company enter into forward contract, you will say yes, because that will reduce your loss by rupees 60,000 or 0.60 lakhs. If they ask whether the decision to take forward cover is justified, you will say yes. So that type of question they will ask you. One more similar type of question, question number 3. This time I will give you the question from exporter's point of view. Okay. ABC Inc., an Indian company exporter, has shipped goods to an American exporter under a letter of credit arrangement which calls for payment at the end of 120 days. Who is the exporter? Indian company. In bracket write down exporter for your understanding, and the American company is the importer. Payment will be received from the American importer after 120 days. Invoice amount is US dollar 2,50,000. So first a simple question. Who is exposed to exchange risk? The Indian exporter or the American importer? Who is exposed to? Come on. Who is exposed to the risk? So your answer will be Indian company. The exporter is exposed to exchange risk because the invoice is in US dollar. The invoice is in foreign currency. And if the invoice is in foreign currency, he will receive the payment in dollar, which he will have to convert into rupees. And after 120 days, the rate of dollar can change. Presently, the exchange rate is rupees 45 per dollar. That is spot rate. So we will calculate at spot rate what amount we would have received. Next line, if the rupee were to strengthen by 6%, now what do you mean by rupee were to strengthen by 6%? It means dollar will depreciate. In bracket write down or nearby write down, it means dollar will depreciate. But please note, if rupee appreciates by 6%, it means dollar will depreciate but not by 6%. That is the mistake which the student can make, but not by 6%. So if the spot rate is 45 rupees per dollar, if rupee appreciates, dollar depreciates. Power of dollar will go down. $1 will fetch less rupees. So to get the expected exchange rate, because now the rate is given per dollar, understand the difference. Rate is for dollar, and this question is more clear as to which currency appreciates, but appreciation is given in rupees. So the expected rate will be 45 divided by 1.06 rupees per dollar. By the end of 120 days, what would be the transaction gain or loss to the exporter in rupees? Second, if the rupee weakens by 5%, which means dollar appreciates. I will repeat, if rupee depreciates by 5%, dollar appreciates, but not by 5%. So the new rate will be, or expected rate will be 45 divided by 0.95. So dollar will appreciate if you divide by less than 1 figure. So this will be the exchange rate rupees per dollar if rupee depreciates by 5%. In the previous two problem, we have directly taken minus 10% because rate was for rupee, depreciation was in rupees. Here the rate is for dollar, appreciation or depreciation is given in rupees. So I need to be careful here. What will be the effect if the company had entered into forward contract for sale of $250,000 at 1 equal to 44? So this time we have actually three situations. Rupee strengthens by 6%, rupee weakens by 5%, gain or loss you have to calculate here, and you have to also calculate the gain or loss if the company enters into the forward contract at 44 rupees per dollar. So I need to know what is the amount I would have received as per spot rate. What amount I will receive if rupee appreciates 6%? What amount I will receive if rupee depreciates 5%? What amount I will receive if I enter into a forward contract? The question is from the point of view of an exporter. Exporter will receive foreign currency and he has to convert into home currency. So he is exposed to the risk. So heading, write down in your notebook, write question number, page number, in bracket important question, heading calculation of transaction gain or loss. Calculation of transaction gain or loss. So this time I have to do 4 calculations. So I will draw 4 columns here. Spot rate, rupee gains 6%, rupee loses 5%, and forward rate. If possible, you take a scale and draw lines. There are so many columns. First point A, write down invoice value in dollar. Invoice value in dollar 2,50,000 4 times, and then point B, spot exchange rate. Rupees per dollar. That is also, so this is spot, others we have to compute. Write spot here. Spot exchange rate 45. If rupee gains, means dollar loses. So to calculate the rate, 45 divided by 1.06. If they will give you in the exam dollar gains 6%, directly add 6%. 45 plus 6%. But if rupee gains, so dollar will depreciate but not by 6%. So the more appropriate answer will be this, 45 by 1.06. 42.4528. Similarly here, rupee loses means dollar gains. So the revised rate will be 45 divided by 0.95. Kindly check the answer. 47.3684. Forward rate is 44. Forward rate is 44. Now can we convert it into Indian rupees? Amount receivable in dollar. Amount receivable in dollar. A into B. This is how much? 1 crore 12 lakh 50,000. Check the answer. 1 crore 12 lakh 50,000. Next answer. 1 crore 6 lakh 13,200. 1 crore 6 lakh 13,200. Next answer. 1 crore 18 lakh 42,100. 1 crore 18 lakh 42,100. Last one. 1 crore 10 lakh. So this is the answer of this question. Under different situation, we have to find out that what is the transaction gain or loss. So now we'll write down transaction gain or loss. Transaction gain or loss. First column dash because this is the spot rate. We have to compare with the spot rate. I will ask you to answer. At spot rate, the exporter was supposed to receive 1 crore 12 lakh 50,000. Suppose he does not hedge and rupee gains. Rupee gains, he will receive 1 crore 6 lakh 13,200. He receives less than what he was expecting. So there is a transaction loss. 6 lakh 36,800. Exporter will always lose if home currency appreciates or foreign currency depreciates, because he will get lesser rupees. In this case, he will be happy. His home currency is losing, but he will be happy, he will be dancing. Okay, why? Because he will get more rupees. He is more interested in his bank balance rather than what happens to the national pride. So rupee loses, enjoy. You are getting more rupees on conversion of dollar. So the exporter will get 5,92,000 more, 100 more. Compare with this number. Okay, you have to compare with spot value. And now you tell me, if the forward contract is entered into at 44, what is the gain or loss with respect to spot rate? 1 crore 12 lakh 50,000, and here is getting 1 crore 10 lakh. He is getting 2 lakh 50,000 less compared to spot rate. So there is a transaction loss of 2 lakh 50,000 if he enters into forward contract. I can't say whether the decision to enter into forward contract is good or bad, because if I look at this column, forward contract is good, but if I look at this column, the forward contract is bad. So don't write any comment, because two scenarios are given. If only one scenario was given, then you could have commented. If suppose in your exam only this scenario is given and forward is given, the decision to take forward cover is good. But if suppose this scenario is given and forward is given, then the decision to take forward cover is bad. So that was this wonderful question number 3. Now we'll take one exam question. May 2003 exam, 6 marks, whether to cover using forward contract or not to cover. In September 2012, ASF Limited assesses the March 2013 spot rate per pound sterling at the following rate. So this company is right now evaluating what will be the exchange rate in March 2013. Sitting here on September 12, they are estimating what will be the rate on maturity, that is March 2013, 6 months down the line. And then this time, instead of giving appreciation 5%, depreciation 10%, 6%, they have given you the possible spot rates and their probabilities. So this is nothing but bonus mark in the exam. So these are the 5 possible exchange rate in March 2013, and these are the probabilities that these rates will be realized. The question is, what is the expected spot rate for March 2013? It is like asking a school level question. How do you calculate the expected spot rate? You will multiply exchange rate into probability. Exchange rate multiplied by probability, then you take the total, and this is your first answer, and you get 3 marks for that. Amazing. Then the next question is, which is also very easy. So you will get one expected spot rate here, some answer you will get. Second, if the 6-month forward rate is $1.40, that means if you want to take a forward contract, the forward contract is available at $1.40 per pound. $1.40 per pound. Should the firm sell forward its pound receivable? Should the firm sell forward its pound receivable? So this company is going to receive some pound, and if they enter into a forward contract, the pound can be converted into dollar by applying $1.40 per pound. Should the firm sell forward its pound receivable in March 2013? This I will compare with the expected spot rate, and then we will be able to comment. Is it right? So first thing first. First thing is, what is the expected spot rate for March 2013? Write down. Calculation of expected spot rate. So I will give you the format and you will solve it for me. Just draw 3 columns: exchange rate, probability, expected spot rate, and you have to multiply these 2 columns and take the total. Solve, take the answer. The answer is $1.405 per pound. Check the answer. The answer is $1.405 per pound. This is first answer. Look at the second question. If the 6-month forward rate is $1.40 per pound, should the firm sell forward its pound receivable in March 2013? Should the firm sell forward its pound receivable? Forward rate, think about it. This is expected rate, and the forward rate is $1.40 per pound, and it is pound receivable. You are going to receive some pound. Let us say you are going to receive 1,000 pound. So if you receive £1,000 and if you apply expected rate, you will get this many dollar. And if you apply forward rate, don't write anything, you'll get this many dollars. So you'll get more dollar on conversion of pound as per expected spot rate and less under the forward contract. So your answer will be that we should not hedge. We should not enter into a forward contract because the expected spot rate is higher. The firm will receive more pound at the expected spot rate. So write a note, the company should not sell forward its pound receivable, at 6-month forward rate of $1.40. At 6-month forward rate of $1.40. Why? Next line. The company can get higher amount. The company can get higher amount in dollar. The company can get higher amount in US dollar by keeping the exposure open. By keeping the exposure open. By keeping the exposure open. Next line, write down. If the company takes forward contract, the expected loss, because all these figures are expected, the expected loss per pound will be, 1.405 minus 1.40, and that is equal to $0.005 per pound. That is $0.005 per pound. This is usually the answer they will write in the exam, but you write one more note. However, if the firm is extremely risk averse firm, I will dictate, right? If the firm is extremely risk averse firm, it will still enter into forward contract. If the firm is extremely risk averse firm, it will still enter into forward contract because the expected spot rates are based on forecasting, and expected spot rate may or may not be realized. A forward rate is more certain. Therefore, the ultimate decision to hedge or not to hedge, depends on the risk averseness of the firm. So this is the answer of this question. Now we'll come to next question. Another highly tested question in the exam. Question number 5. Again write down important. This question was asked in November 98 and you will see it has got repeated also. So one or two more repeat questions also we will take for practice. ASF Limited, an Indian company, has an export exposure, underline export exposure. So it is going to receive payment 10 million yani 100 lakhs yen payable by September end. 10 million means 100 lakhs yen. Yen is not directly quoted against rupees. The current spot rates are INR per USD, JPY per USD. JPY, Japanese yen. Now in this question, they are testing your one more concept of cross rate. Cross rate rule 1. INR per JPY will be found out by INR per USD into USD per JPY. INR per USD is given 41.79. JPY per USD is not given. Sorry, USD per JPY is not given. Instead of that, JPY per USD is given. So I will take reciprocal of that, because I need USD per JPY. I have been given JPY per USD, so take reciprocal, and whatever is the answer, that is the spot rate between INR and JPY. So one more testing, one more extra step they have increased, that first you will have to find the spot rate. It is estimated that yen will depreciate to, estimated. Now this is estimated rate, expected rate, forecasted rate. Yen will depreciate to 140 level and rupee will depreciate against dollar to 43. So your expected rate will become, in this example, 43 into 1 by 144. And now they have given forward rates also. Forward rates for September are INR per USD, JPY per USD. So my forward rate will be 42.89 into 1 by 137.35. So a student has to first prepare this small working notes and find out what is spot rate, what is expected rate, what is forward rate, like previous problems, and then you solve. Under spot rate, expected rate, forward rate, what will be the amount received in rupees? You are required to calculate the expected loss if the firm do not hedge. So expected loss if the firm do not hedge means you will calculate first rupee inflow at spot rate, rupee inflow at estimated rate, and the difference between the two is your expected loss in the absence of hedging. How the position will change if the firm takes forward cover? Again, compare the rupee inflow under spot rate and rupee inflow under forward rate. Take the difference, that is your gain or loss if the firm takes forward cover. And the third question is, if the spot rate on 30th September 2012 was eventually INR per USD 42.78 and JPY per USD. This is actual rate. This is for post-mortem purpose. Okay, that you found that the actual rate was 42.78 into 1 by 137.85. So this will give you actual rate. Compute rupee inflow at actual rate. Compare with rupee inflow at forward rate. And then answer this question whether the decision to take the forward cover is justified or not. So if the forward cover gives me more rupee inflow, then decision is justified. If the forward cover gives me less inflow, then the decision to take forward cover is not justified. So this is how the treasury department of companies do the analysis so that they can take proper decisions. First step would be to find the exchange rates: spot rate, estimated rate, forward rate, actual rate. 4 rates I have to find. So why not to prepare in a tabular format for easy presentation? Write down the heading: step 1, calculation of exchange rates. Calculation of exchange rates. Serial number, particulars. Third column, calculation. Under calculation, write down the cross rate formula. INR per yen is equal to INR per USD into USD per yen, and in the last column we'll write the answer rate, rupees per yen. Rupees per yen. Format is ready. Draw columns. Keep a gap of 1 line after each calculation. First point A, spot rate 41.79. Question is in front of you. First paragraph. Divide by 129.75. Because you have to take reciprocal of 129.75. So divide. You will get 0.3221. Expected rate. 43 by 144. 0.2986. 0.2986. Forward rate 42.89 by 137.35. Point 3123, and then write actual rate. Are you getting 0.3103? So please remember, I am going to use these 4 rates in further calculations. 0.3221 spot rate, 0.2986 estimated exchange rate, 0.3123 forward rate, that is the rate at which you have logged your rupee inflow, and this is actual rate for doing analysis whether your decision was right or not. So first what I'll do, I'll calculate rupee inflow by applying these rates, and then calculate the gain or loss, and then we will be able to write the proper comments. Step 2, write down. Step 2, calculation of expected loss. Serial number, particulars, spot rate, expected rate, forward rate, actual rate. Take a scale, draw the columns, keep a gap of 1 line between each row. You will be able to understand better later stage when you revise. So first point A, write down amount receivable in yen. In bracket write down in lakhs. Amount receivable in yen in bracket lakhs. 100, 100, 100, 100. Point B, exchange rate. Rupees per yen, bracket step 1. In bracket step 1. Go to step 1, last column. 0.3221. 0.2986, 0.3123, 0.3103. Now I will ask you a question. Do I need to multiply or do I need to divide to arrive at the amount in rupees? So point number C would be amount receivable in rupees. Amount receivable in rupees, you will multiply because the first line is in yen and in second line rate per unit of yen is given. So therefore I will multiply rupees in lakhs, write down in bracket rupees lakhs, 32.21, calculation without calculator, 29.86, 31.23, 31.03. These are the amounts I will receive. At spot rate, I would have received 32.21, but because the payment will be received after 6 months and if I do not hedge, then my expected inflow will be 29.86. So that will result into expected loss of 2.35. So write down loss in rupees lakhs. Loss in rupees lakhs. Understand, you are supposed to receive 32.21, but at expected rate you are expected to receive 29.86. So therefore you will receive less rupee. Less inflow means loss. 2.35 lakh rupees loss. Now you compare this. At spot rate you are supposed to receive 32.21. If you take a forward, you will receive 31.23, but this is a logged figure. You are certain to realize it. Still, compared to spot rate, you are going to receive some lower rupee inflow. So loss will be 0.98 lakhs loss. Now you compare with actual. Compare this with actual. Had you just waited for 6 months and done nothing, then you would have received 31.03 lakhs. Compared to spot rate, your loss will be 1.18 lakhs. So the loss is minimum here. When you take a forward contract, if you do not hedge, this is the loss. If you hedge, this is the loss. Actual loss would have been so much if you have just waited. So the decision to take the forward cover is justified because if you compare the losses, the loss is minimum. If you compare the rupee inflow, the rupee inflow is higher in the case of forward contract. So now we have to write down the answers as per the question. The question says expected loss if the firm does not hedge. Expected loss if the firm does not hedge. That is my first question. So you will write the expected loss if the firm does not hedge is rupees 2.35 lakhs. Is rupees 2.35 lakhs, this figure. That was your first question. So answer A. Answer B. How does the position change if the firm takes forward cover? If the firm takes the forward cover, the loss will be reduced to rupees 0.98 lakhs. The loss will be reduced to rupees 0.98 lakhs. The loss will be reduced to rupees 0.98 lakhs. Third question is whether the decision to take forward cover is justified. So you will see the loss is lower in forward, or inflow is higher in forward, so decision is justified. So present the answer neatly by writing proper notes. The decision to take forward cover is justified. The decision to take forward cover is justified as the actual loss would have been higher by rupees 20,000. As the actual loss would have been higher by rupees 20,000. As the actual loss would have been higher by rupees 20,000. Why higher by rupees 20,000? If you want to write this calculation, in the absence of forward contract, the loss would have been 1,18,000. With forward contract, the loss is 98,000. So therefore, you could save 20,000 rupees by entering into forward contract. In bracket approximately, because figures have been rounded off. Rates have been rounded off. Rupees in lakhs have been rounded off. So approximately, this answer is over. One more very similar question, number 6, was asked in the exam, but that year is not mentioned there, no problem. So we will solve in the notebook only. What is the question number 6? Same to same problem with different figures in different exam. At the end of August 2008, the Indian company, an exporter, underline exporter, has an export exposure of, now this time they have changed the currency to Hong Kong dollar and the amount is 5 lakh, due at the end of September 2008, and today we are sitting on August 2008. Hong Kong dollar is not directly quoted against Indian rupee. Current spot rate, like previous problem, I need to apply cross rate rule 1 and find out the rate between INR per HKD, which will be INR per USD into USD per HKD, and in order to get USD per HKD, I will take the reciprocal of this figure. Okay, it is estimated, this is estimated rate, that HK will depreciate to HK dollar 2.5 level and Indian rupee will appreciate against US dollar to 47. So I will use these two rates to find estimated rate. 1 month forward rate, this is forward rate. At the end of August are HKD per USD 2.45, INR per USD 47.04. So this will be for forward. Calculate expected loss if hedging is not done, how the position will change if the firm takes a forward cover, and if the spot rate on 30th September 2008 are eventually, this is the actual rate, is the decision to take forward cover justified? If I look at these two questions together, this is like twins. Okay, the previous problem had yen, that is Japan, now little closer Hong Kong, and they have just changed the numbers. So we will also do the same thing, change the numbers. Right, step 1. Now this time you don't require so much of explanation, it is just one more practice. Practice makes man, woman and a student perfect. Serial number particulars calculation rate. Serial number particulars calculation and rate calculation column INR per HKD equal to, this is cross rate rule 1, INR per USD into USD per HKD. Last column write down rupees per HKD. Last column rupees per HKD. Now we have to compute 4 rates: spot rate, estimated rate, forward rate, actual rate. One by one, you can also start on your own. Spot rate 46 divided by 2.3. Don't multiply because rate is given for HKD per dollar. I need dollar per HKD. So is the answer 20 rupees? Then write down expected spot rate. Keep the question in front of you. Second or third line. 47 divided by 2.5. 18.8. Forward rates. Forward rates. Fourth line. In question 47.04 divide by 2.45. 19.2. D. Actual rate. September. Last paragraph. Last line 47.88 divided by 2.52. We are getting 19. So now these rates will be used to convert the export receivable in Hong Kong dollar into Indian rupee, and then we will check what is the loss under estimated rate, forward rate, actual rate, and whether the decision to take the forward cover was justified or not. So please come to step 2, calculation of expected loss. Calculation of expected loss, step number 2. Same format I'll draw, because if you do the similar practice, you can do it faster. Serial number, particular, spot rate, estimated rate, forward rate, actual rate. Serial number, particular, spot rate, expected rate, forward rate, actual rate. Now write down point number A. Amount receivable in HKD, in lakhs, in lakhs, in lakhs, write down. These figures are in lakhs. 5 lakhs HKD, 5 lakh HKD, 5 lakh HKD and 5 lakh HKD. Point number B, exchange rate, rupees per HKD. If possible, write down always the source of that information. Step 1. Go to step 1, last column. 20, 18.8, 19.2, 19. Point C. Amount receivable in rupees. Amount receivable in rupees. Amount receivable in rupees, A into B. In lakhs. In lakhs. Why A into B? Because this is in HKD, the rate is also per HKD, multiply. So this is easy calculation. 100, 94, 96, 95, 100, then 94, 96, 95. Loss in rupees. Loss in rupees. If you just wait, then expected loss will be 6 lakh, because you will receive 6 lakh rupees less than compared to the spot rate. Now tell me, if you take a forward cover, then compared to the spot rate, what will be your loss? 4 lakhs. And suppose you don't do anything, just wait for 1 month, you will actually receive 95 lakh. So compared to the spot rate, you will lose 5 lakh. So you have to suffer loss, but the loss is minimum if you take forward cover. So the decision to take the forward cover is justified. Now in the exam you have to write the answer in such a manner that they give you full marks. So write question by question. Question was calculate expected loss if hedging is not done. So we are answering that question. The expected loss if the firm does not hedge. Expected loss if the firm does not hedge is rupees 6 lakh. Then same question says how the position will change if the company takes a forward cover. So write down answer B. If the firm takes the forward cover, the expected loss will be reduced to rupees 4 lakh. The expected loss will reduce to rupees 4 lakh. And then see whether the decision to take the forward cover is justified. So compare that with actual. At forward rate you receive 96 lakh, 4 lakh less than spot rate. If you do nothing, wait for 1 month, you will get 95 lakh, 5 lakh rupees less than spot. So the answer is yes. The decision to take the forward cover is justified. Yes, the decision to take the forward cover is justified. As the actual loss could have been higher by rupees 1 lakh. Actual loss could have been higher by rupees 1 lakh. That is in bracket 5 lakhs minus 4 lakhs. 5 lakh minus 4 lakh. So this answer is over. Now we'll take a break.